Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we're back here on the Investor Coaching Show. I'm Paul Winkler. Evan Barnard here. Talking Money and Investing. PaulWinkler.com is the website. You can get video, audio. If you want to learn about Social Security, we got it there. You want to learn about Medicare, we got it there. You want to learn about taking income in retirement from a more academic standpoint, well, we got it. It's in there. It's like spaghetti sauce.
Prego.
That's right. It's in there. All right. Evan, you were throwing some nerd stats at me, and
yeah.
Let's see if we can make that fun, because stats can be a little bit dry, but those were interesting. Those are good.
Yeah.
I thought you were talking about so when let me set it up. When we invest, we talk about often the underappreciated, I guess is the word comes to mind.
Nerds or what?
No. International's underappreciated.
Yes.
The big mutual fund companies, you almost see, literally you did. I talked about cash flows earlier, and I was talking about cash flows in 2024. The reason I did that, I used 2024 on Channel 5, was to point out that, hey, what did the absolute best in 2025? And 2026 so far has been really good as well. But the international side of things, by far, much, much better. But that's something that if you look at the stats on where the money was flowing, and you look at the top 10 holdings or the top 10 areas that were invested in 2025, international was only 1 out of 10. I was literally nothing as far as comparatively compared to what was going to U.S. stocks. International is really, really, it's an important thing because you just don't know. We're one country out of a world of countries. And when we look at diversifying portfolio, we'll often talk about mixing it up, not evenly necessarily, typically just a little bit more in U.S. And you say, well, why a little bit more in U.S.? Well, you're a U.S. citizen. You're going to be more sensitive to dollar versus other currencies. And that gets a little bit above and beyond what I want to get to here in the show, because it's a little bit complicated. We tend to buy more services versus manufactured goods as you get older and blah, 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 blah. It's complicated. I'm not going to and I just did. Anyway.
We don't want you tapping the back of the car in front of you while you're listening.
Yeah, it is. And I apologize. It can be really complicated. But typically what I'm doing is I'm dividing up between U.S. and international with a little bit of an edge toward U.S. But we look at it and say, well, what is the division of U.S. versus international worldwide?
Right.
Evan, what is that?
Yeah. And so if you look at the global market cap, meaning the way I always explain it is add up the value of all of the stocks out there, not who owns them, but what they're worth. U.S. companies currently make up 61% of the world market cap.
And that's why we're doing so poorly as a nation. Everybody wants to leave.
We are far and away the biggest hog at the trough, right?
People getting rafts to come to the U.S. still.
And just to editorialize, this is not academic data. That's why Trump is able to use tariffs as leverage. We're 61% of the world market.
Big deal.
Everyone wants to do business here.
That's right.
But the interesting thing is U.S. companies are only 51% of global earnings.
That is fascinating.
And so there's a couple of pieces of data that I want to throw out to create the comparison.
Now, why is that fascinating? Are you going to get there? Are you going to go?
I think so.
Okay.
If not, clear it up for me.
I will. Okay. Yeah. Go ahead.
Yes, master.
No. Don't stop that.
The normal PE, price earnings ratio, how much do I have to pay for a dollar of earnings?
Yeah.
Is a 16-to-1 typically for large U.S. companies.
Yep.
Historically. Right now, large U.S. companies, the PE ratio, average PE is about 25 or so. And international large companies, the PE is about 17, which means they're a much cheaper buy. Emerging market PE ratios in the aggregate are about 17. Well, the Mag 7 that we were talking about on an earlier segment that is really concentrated in a lot of people's portfolios and makes up I think like 30% of the S&P 500, just those 7 stocks are close to it.
It was 40 last time
40?
I looked,
Okay.
but it might be a little bit less than
I
now
know the top
because of
20
what it's been doing
companies
recently.
are like half the index.
Yeah. Uh-huh.
Their current average PE is around 45 or 50, depending on which week you're looking at the price.
Yeah.
And so you look at that and say, well, they're a huge, huge component of the U.S. market cap. And so we have this incredible value, but those companies aren't really earning tons of money right now. A lot of it's betting on
They're spending.
We think they're going to be doing great 2, 5, 10 years from now.
Well, they're spending a ton of money on AI right now. Yeah.
CapEx and building these plants and buying chips and so forth.
Yeah.
And so it was just kind of an interesting conversation of it makes it hard to pick stocks for one thing.
Well, sure.
I've got a separate thing on that, but it was just a very interesting deal. And then if you start to slim that down or, slice it up within the U.S. market, 42.5%. So this is not of the world. This is 42.5% of U.S. market cap is concentrated in 127 AI companies. Now, when I say AI companies in terms of this data, it's not all NVIDIA's and Google's.
Yeah.
Like Caterpillar is part of that category.
Okay.
Because they're radically using AI with, some of the stuff they're doing. So
interesting.
It's not necessarily everything, they're not all what we would consider a tech company.
Right. Okay.
Internationally,
that makes more sense now. Okay.
32.7% of the international market cap is concentrated in 213 AI companies. And so it's interesting that just you have these concentrations and the price and the earnings, kind of all over the map. But it's that's why you want to rebalance and it's why you want to diversify. Frankly,
and you look at why U.S. companies are selling for such a high price compared to international counterpart, and does that mean you need to just load up like crazy and forget U.S. and go all international?
Right. Yeah,
that's exactly what you'd be led to do. But the reason that it would be selling for a lower price is because there's more risk for those earnings coming into the future. Because you look at what's been happening politically, we talk about politics and people worried about what's happening here in the United States. We're actually trying to secure borders and those types of things. Well, a lot of those other countries around the world, they're not necessarily doing that. And in essence, what's happening is that it is threatening some of their economic growth. So you look at that and say, well, what could turn that around? Well, there is a push right now, and will it turn into something? I think things go through cycles, and you can't predict them.
Yeah.
Whereas for a while, we kind of got a little bit loose on some things here in the United States. Now we're tightening up, and you get other countries around the world. They kind of become a little bit lax in some areas. Maybe they have high taxes, or they have very high regulation in those countries, and they recognize that it stymies growth. Think of in the 1980s. When you look at places like Norway, Sweden, and Denmark, and those countries tried socialism to a great disaster.
And they went all in.
They didn't
just put their toe in the water.
Oh, yeah. And then what ended up happening is they were just bleeding. And it was really, really hard for them. And then all of a sudden, you have people saying, "Oh, look at all the growth. Look how great Denmark, Sweden, and Norway. Look at the Scandinavian countries. Blah blah blah. Look at the miracle of them." Well, they didn't start talking about the miracle of these countries until after they had abandoned their socialist ways.
Right.
So this stuff goes through cycles, and people they want to have the best for themselves, their families, their country. And it goes through cycles.
Yeah.
And that's the reality of it. So you look at this and say, okay, well, maybe that is going to start, the tide will turn over in overseas markets. But when will that happen? You don't know. And here's the thing.
Yeah.
When the tide, let's say that you have the person elected or the people elected, they start talking about it. The changes in the stock markets typically far precede the actual changes in the economies happening. Stock markets will anticipate. They will go up in anticipation of things getting better. They won't go up when things get better. So if you're sitting there looking at this thing and going, I'm going to wait till things get better before I own these market segments. Recognize that when the news comes out that tells us that 2 years, 3 years, 4 years hence, things are going to be really, really good, stock markets will go up in anticipation. They'll go up beforehand, and it's too late once the information comes out that tells us that there's likely to be something good coming down the road.
Yeah.
And it's really important to understand that.
Well, and even if things do turn out well, an example you use a lot is James Carville. It's the economy, stupid. And Clinton.
That's right. Yeah.
And so even, let's just say the economists, market prognosticators, gurus, whatever, forecast a 10% growth. And you say, it's great. And we get a 7% growth, which is great. But we thought it was going to be 10. And so we've grown and the market goes down. And you're like, well, wait a minute. This was good news. It's supposed to be doing well. It's not as good as we wanted it to be. Right. And you get clobbered.
Yeah, and that's a good example right there. So, you got to be really, really careful of these things. You listen to this information, listen to this news, and then a lot of times people will try to act on it to try to better themselves and not recognizing that that's just not the way markets work. They are anticipatory, they are forward-looking, and they act. And people will buy, they have to pay more. They hate to pay more when things are going to get better, but they have to because the people that own stocks don't want to let go of them for the old rates. Yeah. It's pretty interesting. There was something, anything more on that, Evan?
Not on that topic.
Not on that topic. Okay. We had something that was interesting this week, changing gears a little bit. Yeah. Somebody had actually called up and says, hey, I've got this investment and I want to know what you guys think of it. And this is a call that Chad took.
That's a brave person.
It's funny. We have clients that'll call up, and they're not ashamed to call up and ask stupid questions. Right. So I am so happy when they do that. I always tell people, call and tell me what you're thinking of doing. Don't call and tell me what you did.
Right.
Because then I can't fix it.
Some bells you can't unring.
No, that's exactly right. But it was an investment that paid 9 to 13% annual interest rate.
Okay.
And it was, Chad found the ad for it. It had a 4.7 out of 5 rating, which I think is so interesting that these companies will put stuff out there. Look, hey, look,
they're rating on
I don't know
Google
about you
or whatever.
Yeah, I don't know about you, Evan, but it's just the rating services out there for things. That is a pet peeve of mine. Where you'll have something that you're going to buy and then you have terrible ratings. And there are companies out there, this is happening right now.
Oh, yeah.
This is literally happening where overseas, they are putting bad ratings on companies, on local companies. And they are contacting those companies and saying, if you want us to remove our rating, you owe us money.
Oh, gosh.
I don't know if you'd heard that.
No, I hadn't. I knew that there was, like robot farms or just... boiler rooms of people you see these, looks like a closet, but it's got like 400 phones in it. And people are just commenting, not commenting, but saying either give it 5 stars and it's bogus.
Right.
Or 1 star, which is also bogus. Right. I hadn't heard about the holding the company hostage.
Yeah. Getting money out of them. Yeah. Extorting money out of them to remove their bad rating. Jeez. So it's super, super frustrating. And it's like with investing, we've talked about this, 4 and 5 star ratings on mutual funds and things like that's meaningless. The Wall Street Journal has done tremendous amount of work and a lot of articles talking about how useless those ratings really can be when it gets down to it. So this one, 4.7 out of 5 stars.
Okay.
That was the rating on it. And they said, hey, what do you think about this? And I always tell people, trust your instinct. What's your instinct say? There's no return without
risk.
Yeah. So the fine print. This company is an LLC doing business as blah, 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 name of the company under Reg D. Alternative investments are speculative, illiquid, and you may lose some or all of your investment. That was in the fine print.
That's not as good as 9 to 13%.
No, but if I were to try to take a gander at how much bigger the print was on the 9 to 13 versus the print at the bottom, I would say it's probably about somewhere in the neighborhood of 30 times as big.
32.
Yeah, and to see that, Evan, that's
32 versus 4.
Yeah, it's pretty big, right? So anyway, you're listening to Buyer Beware. You cannot trust. You can't just blindly look at something and go, "Oh, this guy." People say, "Oh, you need to talk to my financial advisor." I heard this a lot in the late 90s.
Yeah.
People say, "Oh, they told me to go talk to their financial advisor." Because the advisor had done really, really well. And I would stop them and go, whoa, wait a minute. You have to know what you're doing, why you're doing it, what to expect. You may have had good results, and this is indeed what happened. People had financial advisors managing portfolios for them that were very, very heavy in tech stocks in the late 90s. Mm-hmm. And then when the 2000s came around, the advisor didn't look so smart anymore. You'd need to be engaged in the process. What am I doing? Why am I doing it? How does this work? You don't need to know everything, but there are certain things it's critical that you understand. And risk and return is probably the first thing that you have to understand. They are related. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here. This is the Investor Coaching Show. Paul Winkler, Evan Barner, talking money and investing. paulwinkler.com is the website. That's what we do. And Evan.
I was just going to say, thinking about the last segment is, if you're sitting out there and you've got a email invitation to some crazy investment webinar or some flyer or something that you've gotten and you're curious about it, you can always go to paulwinkler.com/question or questions. I think they both work.
They both work.
And just drop that in there, and not a stock. It's not like, hey, what do you think about NVIDIA? That's not what we do around here. But if you have something that could be too good to be true, shoot it to us. We can investigate it. And I think you guys can even send a clip of that segment. Yeah. Because we'll have the email or something. But
Yep. We do that. Yeah.
Don't be embarrassed.
And, there was somebody asked a question. They were talking about gold on TV. Apparently never heard the radio show before.
It's like,
what do you think about this?
People calling Dr. Laura.
Yeah. I'm like going, no, don't do that. It's just the reality of it is, if you never heard me talk about that, okay, so gold is not an investment because it goes up and down based on supply and demand, and you don't have any cost. Nobody's paying you to use your money. If I'm looking at an investment and say, what causes this to be an investment, it has to have a cost of capital. It's like, for example, people own real estate all the time. They like it because it pays rent. And I'm like, you like it until you get up there in age and you're like, I don't want to take care of this stuff anymore. But, in place of that, I can have, companies and own stocks, and I can own companies all around the world, and they have earnings, where I can have interest-bearing CDs or things that pay interest, but then you're dealing with inflation in that particular instance. But these investments are investments because somebody's paying to use your money. There's that growth that we see with corporations historically, that we can participate in that growth, all around the world. And that is an investment. But if something is just going up and down based on, is there more demand for it? And I talked a little bit about that one article I saw a while back. I don't know if you heard me talk about this, Evan. There was a thing that they had done. We were talking about being able to produce gold and be able to make it.
Yes. Yeah.
I said, what if like, that's true? I mean,
make gold out of rock. Yeah.
We got into a big conversation on diamonds in here in the office.
Oh, okay.
Yeah, that was really fun yesterday. Chad was telling us all about diamonds. I had no idea. He was talking about how they are different. You know, all diamonds are going to be a little bit different, but the man-made diamonds are all like uniform and the same. And,
the lab-grown diamonds?
Yeah, lab-grown. And I said, I have no clue about any of that stuff. But I thought that was
They say chemically they're the same.
Yes, yeah, but it's something about the imperfections.
Yeah,
was one of those things. But yeah, so anytime when somebody is coming in saying, "Hey, you're going to get a return," and a lot of times insurance products are sold that way. You can get return, there's no risk, and I'm asking people, "Hey, where does the insurance company invest your money? What do they invest in?" And I don't know. Go look out there on the internet. Read up on what the insurance company is actually investing in. What's their portfolio? It's public information. You can find this information, and you will find overwhelmingly that they're investing in bonds and real estate. You know, so they'll have bonds, but very, very most heavily in bonds. And the reality of it is, if they're telling you that they're going to give you a rate of return that is significantly higher than bonds, but they're investing in bonds, you ought to have a little question mark in your mind saying, how can they do this?
right.
How can they? And the reality of it is, they can't.
The math ain't mathin', as they say.
The math ain't mathin'. I've never heard that one before, but okay. I've heard getting your merds wixed, but... Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.